Welcome to the Finance Magnet Podcast. I'm your host, Ramzi, Head of Growth Marketing here at Finance Magnet Group. And in today's episode, we are going to dive into the dynamic world of finance, a realm where there was like a mix of opportunity and innovations. Our journey, alongside with my guest here, is a span decade of market evolution from the bustling trading floor of the past to the digital marketplace of today. My special guest is a true veteran of the industry, someone who has not only witnessed but also influenced the transformation. From his early days as an ambitious trader to his current role as a leading EBC Financial Group. So let's get ready for an enlightening conversation. Please join me in welcoming David to the show. David, it is great to have you here with us. Maybe we should just start by sharing your journey and how you have reached this point in your career.
Thank you for your introduction. I think it goes to prove why I've got grey hair and I'm older than most people that I speak to these days. But I've been in the markets for approximately 35 odd years now, maybe a little longer. I started off in tier one banks in the old fashioned trading rooms, lots of shouting and screaming and throwing things around. And I've gone through full evolution into digital pricing and the way that we interact with clients. As I say, I worked at tier one institutions. I've also helped set up a hedge fund back in the late 90s when that kind of thing was popular. And since then, I've worked at various institutions. I've set up my own consultancy companies. I've set up businesses and I've helped people establish and grow their own. And then recently, been lucky enough to work for EBC Group. So I'm based in London with my partner, Chris, and the pair of us run the UK and the Cayman businesses.
Just to clarify, I'm agreeing with you on the old fashion throughout the trading rooms. Just because I have witnessed it, I wasn't there personally. I just saw it across on TV, so I'm a bit younger than you. Got some of my hairs going on. That is to say that is an incredible journey, of course, David, and it is clear that your experience has given you a very unique perspective on the financial market. So, we dive right into our discussion, and as we approaching the end of 2023, we start to address that and see how the event of 2023 has shaped the current global market landscape, particularly concerning the asset classes and interest rate.
Yeah. So I think, if we look back on the year, clearly it's been an extremely volatile and a very busy year in most asset classes. But I think there's no doubt in my mind that the main driver of virtually every move in every asset class has been governed and driven by what's been going on in the bond markets. The fixed income markets, interest rates have been incredibly volatile. If you look at what we've seen thus far, I would say, barring years that have had major events, so if we look back to 1997, 2001, 2008, these had huge fiscal events driving the moves in the market. And really, we've not had a catalyst of that magnitude this year, but bonds have really taken over and driven what's gone on. I think, clearly inflation has been a driver of pushing rates up. Global inflation was a surprise to policymakers. You can argue whether that was seeable or not, but I think, the reality is if you had rates at the kind of low levels that we've had for as long as we've had them, it was always coming along at some point. I think the global economic and particularly the political tensions helped that going forward. But, to me, inflation was always going to happen and the market found itself fairly flat-footed. And the central banks really had to run to catch up. So the last 18 months have seen them doing that. And then if we look at what's gone in the last 6 weeks, it's almost as seismic as the move back up from those lows. And clearly, we've retraced a good chunk of the move. But each time the bond market has had those huge surges of interest and changing of pricing, we've seen the knock-on effect to all other asset classes. So I think bonds have been basically the key to the year.
That is interesting and very insightful perspective, honestly, especially regarding the inflation and the political factors in the government, which we do need to tap into that. But I want first we move on to commodities, and especially we saw lately the gold prices have regained momentum, especially with what's going on. Around here, we are here based in Cyprus, so in Middle East instabilities, we see that this how help the gold prices to gain this momentum. Yeah. Do you see the gold as a safe haven for 2024?
I'm kind of, generally speaking, I'm a bit skeptical on what is a safe haven and what isn't. So I had a conversation with somebody a couple of weeks ago about the yen. I don't believe yen is a safe haven, but I think gold has proved to be exactly what people traditionally have looked at it as, which is a safe haven asset. I think there's a couple of things gone on with gold this year that probably the two of them together have been a massive mover, but I think the first one is something that's just not talked about enough. Central banks over the last 12 to 18 months have been buying massive amounts of gold. I mean, in the last 9 months, so the first 9 months of this year, they bought like 800 million tons of gold. That's a lot of gold, and it's probably twice the usual annual rate. China's been a massive buyer. Singapore's been a massive buyer. And strangely enough, Poland is like the third largest central bank buyer of gold. But I think what that tells you is that they're changing the makeup of their reserves. And that demand and change of makeup of reserves is driven by geopolitical tensions, economic tensions, and their need to readjust where they're keeping their cash. And I think that's been a really big driver. And interestingly enough, institutional investors and private investors have been net sellers of gold in the first 9 months of this year. And so I think you can attribute that to the US interest rates. Rates became very attractive for lots of people. When US rates get up to 5%, there's a whole swathe of investors out there that haven't seen 5% forever or a very, very long while. So I think, gold kind of got pushed to the sidelines, but it's no coincidence to me that as US and global rates have come off very hard in the last 6 weeks, we've seen people piling back in and with that extra spike. So the abrupt move that we saw up to 21.50 or wherever it got to that Sunday night, I think that was proof that the underlying demand added by people changing their minds and the market pressure on US rates drove people back into safe havens. I mean, it's quite interesting, again, when you think about safe havens, the political schisms that we've seen. So if you look at the ongoing one in Ukraine and the more recent one in the Middle East, the market has had a remarkable ability to recover from those problems. But I think there's no lack of correlation with geopolitical, geoeconomic, and also that underlying demand that gold's higher. And I suspect, going into 2024, I really wouldn't be surprised if it doesn't keep going, because it's hard to see the reasons that have driven it up here dissipating in a hurry, I think.
Very, very interesting point, especially the central bank bit. I believe that we did cover it throughout our news outlets, but it went under weather, as you mentioned. It wasn't highlighted as it's supposed to be, and that's what happened. When we the shift moved to the political side of the events. I want to shift our focus not far from our topic. I want to speak about the Fed. We've noticed some inconsistency in their signals, especially toward the interest rate hikes. Do you believe we've reached the peak of interest rate? And maybe what does this mean for the actual global economy?
I think your question's a good one. The word inconsistency is quite topical, particularly this week. So, up until this week, the Fed have stuck to their mantra, right? So inflation's still stubborn, core inflation is going to remain high, it's going to take time. And then as we saw at the Fed meeting this week, there's a complete pivot coming. Now, clearly, the US market, the US bond markets in particular, and then followed by other global markets, have pushed interest rates lower. And that's really been driven by data. So the market's been very quick to respond to lower inflation data and, a less obtuse series of data from the economy in general. And it's interesting that the Fed can go from 6 weeks ago saying we're on track, we're keeping going, to just this week turning around and saying, well, actually, we're going to change our dot plot and we're going for 3 cuts next year. The market's pricing 5. But the Fed's decided that from going from nowhere to possibly hiking some more, they're going to 3 cuts next year. That's a big change, right? And it is that word you used, inconsistent, is a good word for it.
Don't you think it seems like we are like at the pivotal point right now? You mentioned the data.
I think so. So I think the sharp decline in core inflation has caught central bankers out. I think, again, bond markets were very quick to jump on it. If you look at European markets, you look at some of the Asian markets, you look at the US markets, they priced in that drop in core inflation, and they've been very aggressive about it. And central banks haven't, right? So, if you listen to the European Central Bank this week, and the Bank of England yesterday, they're a long way from changing their mind, whereas the Fed is being much more pragmatic about it. I think there's no doubt that for the time being, we've definitely seen a peak in rates, and there's no doubt for the time being that the market is looking to push the story and the thought process that inflation will be subdued and that rates will need to be cut. One thing I would say, the interesting thing about the conversation around why rates have come lower. So originally, when rates were at the peak and everybody was still incredibly bullish on where rates were going, everybody started to talk about a hard landing. So the state of the economy and the hard landing seems to have completely disappeared from the narrative. Everybody's focused on lower inflation data, and everybody's sitting there saying we're going to have this Goldilocks soft landing. Everything's great, and we just need to cut rates to accommodate that. It's kind of strange. I read you something I read yesterday, which is something I hadn't realized, but the small caps, Russell 2000 in the States. So it made a 52-week low 48 days ago, and it's just made a 52-week high yesterday. That's some kind of pivot, right?
It is there. I had a recent conversation with some analysts. Actually, we during the conversation, I was talking to them about the podcast that we're going to have today, and they did mention a prediction that it will be a mild fall in the Fed interest rate in the maybe later half of 2024. That's what the prediction is. Should we be more optimistic about this forecast? How do you see this?
I personally think that the market has overpriced it. I suspect there's always this thing. So the market is a untamable wild animal that runs from one place to another and is clearly always on a mission to make something happen. It's like end of year predictions. The only end of year predictions that you guys and us would talk about are the ones that stand out. So everybody predicts half a dozen black swans every year, and we might get one every decade, right? So, and I think in many ways, the rates market is doing a similar thing. I think they're overpricing what could happen. The central banks have probably underpriced it, and the truth is somewhere in the middle. And for markets in general, the bit in the middle tends to be the top of that bell curve, tends to be where we end up on most things that go on. So for me, the market's overdone it. I think to get what the market's pricing in now, you're probably going to need to see a hard landing, right? And nobody's talking about that at the moment. It's Goldilocks. So I'm kind of thinking the truth is probably somewhere in the middle. But I think the danger for the market now is higher for longer. So if the central banks don't play to the market's tunes and they don't cut, so if you listen, Bank of England and the ECB this week, they're in a different mindset to where the Fed are. So, and that's good for foreign exchange markets, because for so long we've been trapped in mean reverting markets that don't have a lot of fundamental things to key off of. If we start to get that disparity of direction from the central banks on their policies, foreign exchange will move. Dollar yen has proved that this year, right?
As long as I want to keep the conversation about forecast, everybody's favorite topics, especially in the foreign exchange market. But I actually want to bring us to a more crucial topics. We mentioned earlier, recession, the big word. How do you see the potentials playing out? And could it actually mirror events like, I don't want to be exaggerating here, like the events happening in 2008 financial crisis or the dot-com bubble crash?
I think if you look at where we are, I think that even the central banks, Powell said it this week as well, the rate hikes that we've seen already are still filtering through the economy. The market generally has moved on from hard landing and recession. But, I have a friend who is a receiver. So his business is looking after companies that have a problem. And that's real world on the ground kind of anecdotal data. And he is busier than he's ever been. And I think that in the real world, that scenario of the higher rates that we've seen come through into the economy are still working their way through. And I suspect it'll probably take a little longer, and we'll see more pain. We're going to see more pain in households. We're going to see more pain in companies with small or leveraged balance sheets. So for me, I suspect it probably remains hard. But the bond market's telling you there's not going to be a recession, right? And again, it's probably somewhere in the middle.
I mean, again, giving these potential scenarios, let's hope nothing will play out. What the impacts do you foresee on the global, maybe on more like regional market in the event of recession?
So I think it's down to where the leverage is and where the shadow banking is. So if you look at places like China at the moment, China is struggling because their economic policies of the past, the results of those policies are coming home to roost. And the problem that you have in places like China and Russia is that you're not going to get a change of leadership, which means that they're going to have to adapt the way that they implement their policies. And that's very difficult in these economies because there's a huge amount of shadow banking, there's a huge amount of shadow lending, and it's very fragile and it's very leveraged. So it tends to have less of a robust shelf life than some of the other things. So, I think you have to, if you look at where might get in problems, it's like looking at global economic balance sheets. I think you need to do that for countries, and I think you need to do that for sectors that are unleveraged, sectors that have strong balance sheets. You have Apple. Apple can sell a phone for $3,000 and people keep buying it, and nobody questions. The fact
prices keep going up with less gadget, and people are not questioning, still buying.
Crazy, right? But nobody questions the stock price. Apple made new highs yesterday, and the reason that it did that was because it has a huge unleveraged balance sheet, so everybody thinks it can do whatever it likes. That's a conversation for another podcast, but I think that's the way you got to look at it. You got to look for people that can weather the stress, and that's true of regimes, industries, as well as different jurisdictions and countries, I think.
Okay, as we prepare for 2024, I think small and big and mid investors, what strategies should they adopt, and where the most important, I think, where do you see the new opportunity emerging? And another more important topic, what we should avoid?
Well, I think 2024 is going to be the year of politics, right? So if you look at what's going on in the States, we're back to where we were. You had two unpopular candidates, very, very split voting audience, 50-50. And, if you look at Europe is swinging to the right a little bit, and I think that will continue. If you look at places like Italy and Argentina, they've gone really off the edge of the envelope in terms of where they voted in. So I think politics and the amount of elections and intra-country elections that we have coming up are going to be a really big player. And I think you have to be aware of the impact that potentially can have. So for me, 2024, I think not having a strong view is probably not a bad idea. I think being nimble and being able to assess what comes around the corner. I spoke to a friend the other day. He said, my best trades of this year have been long bonds and short bonds. all in one year, right? So, and I think that probably says a lot about next year. I think you need to keep an open mind. You need to react to what changes in front of you, and having a strong view probably isn't a good thing. The one other thing that I would say is that if, and I'm still not convinced myself, but if the dollar does come under a lot of pressure next year, if you look at the way that gold's reacted in the past few weeks, I really think that there's potential in a weak dollar environment for commodities to be very, very strong. The irony of that being that it brings back inflation, and guess what? That means we've probably priced in too many cuts, which comes back to my point about being nimble. I think you need to really concentrate on the detail and don't get married to ideas.
Mm-hmm. Maybe now we shift the conversation toward your and company's EBC Financial Group.
Yeah.
Maybe if you want to share with us what you guys have, what the direction is for 2024, and how the company is gearing up for this whole trading environment that we're gonna witness in 2024.
Well, one thing I would say is that as much as that volatile trading environment can be difficult, it's good for people like our business model, right? And I think clients will tend to rely on trusted partners. So EBC has spent a lot of, the UBO and the teams have spent an awful lot of time globally building out their footprint and the different jurisdictions that they're operating in. I was on a town hall last night and we've opened another couple of offices. So growth is there. There's a demand, I think, for people that are there to help rather than just to exploit. We have an ASIC license, we have an FCA license, and we also recently acquired a SEMA license out in the Cayman Islands as well. So the group is trying to do things the good way rather than the easy way, and it's trying to build up something that has longevity. And I think, the expectations of clients now is very high. And I think that the group is positioning itself for the long term, not for the short term hit. And I think we're in pretty good shape. I think, the rise in volatility again will mean more business, but people will need to be dealing with people that they can talk to and trust. And I think that's a big part of the ethic of what the group's doing.
Mm-hmm. David, thank you so much. Your expertise and insight today have been incredibly enlightening. Quick recap: we discussed so many things. We started with the market dynamics, and we moved on to the role of gold as a safe haven. We explored Fed's interest rate, and then we had also examined the recessions. Plus, finally, we did also concluded the investment strategy for 2024. Thank you so much, David, for sharing these insights. This has been truly a thought-provoking discussion. I'm sure also our listeners have gained a great deal from your expertise. Thank you.
No, it's been great. Thank you for having me. Yeah, I appreciate it.
Awesome. You've been listening to Finance Magnet Podcast. We hope today's episode has given you some valuable insight into the financial market trend for 2024. Thank you for tuning in, and we'll see you next time.